as we look at jobs, this is the comparison with the latest recession that we saw versus all the other major recessions since World War II. And the other one that obviously comes to mind is the 2007 recession, which wasn't as deep as this one, but it certainly took much, much longer than all the other ones to get back to full employment. So this one was extremely steep. And we've had good progress, but we're still a long, long way back to where we could be. So if we do take the Fed at their word, maybe they're saying, hey, we're looking at this same chart and we're not going to, I think the exact quote is, we're not going to thinking about raising rates right now. And they may need to see this job number way up here. So I think the point to take away is that, we've had a lot of questions about rates moving higher and inflation moving higher. And what the Fed is saying that they're willing to kind of be a little bit more reactionary to this than they have in the past. So I think we can expect a moderate level of inflation if everything plays out according to plan. If you just look at what the rate complex looks like over the past 5 years, you can clearly see where both the 10-year and then in orange, and then the 10-2 Treasury spread follows right along with that, because the 2-year Treasury has basically just been pinned to the floor. And then you have the market implied inflation rate here at 2%. So rates shot up quite a bit at the beginning of the year. We've leveled off certainly since then, and we came back from a high of 1.8 down to 1.6 when we printed this. I believe that today, last I looked, we were close to 156, 157 on the 10-year. But you think about it, if the 10-year Treasury goes up 5 basis points a month for the rest of the year, that puts us at 2%. And that's not, an outrageous number, though. I think some people would look at that and be scared. Now, looking at just commodities in general, we see this top chart here, the commodity industrial inputs, so things like lumber, metals, things like that. It's pretty clear that the prices of those inputs are going up, and they're going up quickly. On the flip side, you've got food and beverage, same thing, going up. So the Fed can sit and kind of say, hey, CPI is benign or non-existent. But when we look at what's going on in terms of raw material inflation, it's pretty clear that it's happening. And we're seeing it take place right in front of our eyes. So how has all this affected bond returns? Well, we've got a lot of questions about that. And you can see this has been kind of a tough year for the bond market, so to speak. So there's a few lines on here. I'll try my best to point all these out. But down here, you have a security called Zeros. That's the ticker, which is basically the PIMCO zero duration coupon, zero coupon ETF. So zero coupon bond basically has no interest payments. You buy it at a discount and matures to par. And really all the interest payments are kind of phantom. But what's unique about zero coupon bonds is that they have the highest duration of any fixed income security. And then duration is just a fancy way to describe the relationship between how interest rate movements affect bond prices. So if you have a duration of 5, for instance, rates go up 1%, the price of that bond comes down approximately 5%. So these zero coupon bonds have durations in the 20s. So obviously they've been hit pretty significantly, being down almost 16%. Then you kind of start to move up. You have your 7 to 10-year Treasury bond right around here, down almost 4.5 to 5%. You've got your the Barclays Ag, which is basically the S&P 500 for bonds, with a duration of around 5 or 6, down a little over 2.5% here. Then you've got things like the 1 to 3-year Treasury bond, which has very low duration, still slightly negative for the year. And the only thing that you see positive in the fixed income world right now is you're looking at the Invesco high yield bond, which has essentially been a more of a kind of statement on risk taking, so to speak. So the bond world has certainly been a challenging place, and we've continued to try to make portfolio adjustments to address those concerns. Now, lastly, one of the things that that we've seen pop up this year is that as kind of outlandish returns have been condensed into a very small window, clients' expectations have shifted a little bit. And there's this concept called hyperbolic discounting. It's a behavioral finance concept. And if you look here, it's the idea that we want instant gratification. So we want something that we can have now instead of waiting for a better outcome far in the future, even though we can get that outcome. So this chart here, would you rather have $50 now, or would you rather have $100 in 1 year? So the devil on this stick figure shoulder is saying, we want $50 now. The angel's saying, we want $100 in 1 year. You can also see here, this is another way to look at it. What do we want? We want instant gratification. When do we want it? We want it now. So nowadays, think of how many times you check your statement, your account balance in a month. Probably 30. Probably do it once a day now that we have access to it. And as we look at some of the returns that we've seen, it feels like investors are, I guess, reaching for some of these outlandish returns, feeling like they need that instant gratification, almost a fear of missing out, instead of kind of sticking with tried and true methods that they know over time will work, but it's just not as exciting.